It's Don Kaufman doing the Theo Trade evening video for August 3rd, 2020. We are seconds after the cash close on this Monday afternoon with the S&Ps up some 22 handles on relatively light volume. Kind of left off where we were last week. And what does that mean? The monsters of tech are driving everything. And then there were two. What I'm referencing here, there's two stocks today, Microsoft and Apple, and those market caps are literally driving not only the NASDAQ, but the S&Ps higher. And what we're going to discuss in this evening's video is, do we have to have this kind of quintessential breakout to be able to effectively break down? For those of you that speak Trader Geek, that probably makes quite a bit of sense to you. If you're a little newer, well, don't worry. We're going to explain that here in this evening's video. Let's get to work. As I was saying moments ago, the volume out there, it's kind of lackluster. We're going to be lucky to do like 1.2 million contracts in the S&Ps. For those of you, again, that are not necessarily Trader Geeks, what does that mean? I'll tell you exactly what it means. Looking at the S&P futures, it's light out there, people. Really light. I mean, again, we've seen a considerable amount, if you will, of some of this, lighter trade in some recent trading days. But hey, here we are actually ready to break out to the upside, but it just doesn't feel like, that kind of breakout volume, if you will. The other thing that is, you can't dismiss this whatsoever, and that is the S&Ps ultimately opened and we closed slightly lower. Yeah, they're still bid up. Yeah, we're up 0.7%. And yes, it's all about the NASDAQ. But as I said a moment ago, and then there were two. I mean, you got Microsoft, you got Apple to the upside. But let me actually make a really kind of quick point with this. Listen, there are marquee stocks today, literally marquee stocks that are down in the midst of the S&Ps being up 22 points. And that, there's a big question mark, right? I mean, we're nowhere near correlation. Now, for those of you, again, this is a little bit more in depth. When I talk about correlation and correlation coefficients, typically when you have the S&Ps up, and the S&Ps are up any more than about 0.5%, what you would typically see, all right, is more correlation. What is this? This is like slugfest. I mean, you have 63 stocks to the upside. You know what? This is it's looking at the S&P 100. Let's go let's get a little crazy. And we're going to look at the full S&P 500 first of all in terms of the sectors themselves. Does that look like a healthy market when you technically have more sectors down? It doesn't matter anymore. IT, tech drives everything. When we also start to look at the advanced decline line, I'm just going to look at the advanced decline line for the entire S&P 500, and I want you to see, for the most part, it's a 50-50 out there. But as I was saying a moment ago, and we'll snap back to the S&P 100, not even the S&P 100 matters anymore. I mean, you could literally come up with a new index, the S&P 20, because it's whatever Microsoft and Apple are doing. And again, Apple right now is facing close to a $2 trillion market cap. I apologize. That one's a little bit difficult to say. Now, as I was saying a moment ago, there's marquee stocks that are trading to the downside. None other than, of course, Facebook. Facebook starting to feel a little sell-side activity, specifically towards later in the day, also drifted a bit lower. We've got none other than Amazon seeing some sell-side activity. This is much more substantial, of course, than Facebook. Last but not least, Google. Google, we'll just call flat on the day. But I wanted you to see that, how crazy is it that the S&Ps can be up 22 points, which is a fairly decent rally. Not all of tech is participating. You're like, wow, but Don, there's other stocks. Really? Like the financials? And the financials finished massively unchanged on the trading day? I know. Okay, you're going to tell me energy. The energy sector, that's up 0.3%. There's nothing right now. Okay, there's nothing but Microsoft and Apple. Other marquee stocks, if you look around a little bit, Walmart's flat on the day. Caterpillar actually sold off the flat on the day. Starbucks down on the day. JP Morgan off on the day. But banks, generally speaking, were flat out there. But I wanted you to see, again, without the help of any of the big-time marquee stocks, it doesn't matter anymore. And I'll tell you why it doesn't matter. Because when you have an Apple, and an Apple, again, has the market cap approaching, $1.8, $1.9 trillion. Right next to it, of course, is none other than Microsoft with a $1.6 trillion market cap. Not much else has to happen. And this is why I keep talking about the death of diversification. We now have very close to 25%. That's right, 25% of the S&P 500. We're closing in on 25% of the S&P 500 being vested specifically inside of 5 different companies. By the way, Google is kind of technically counted twice. Nevertheless, it's 5 companies. All right, moving on over there. As I said a moment ago, the advanced decline line really resonated with me, even though the S&P is finished up and quite substantially so. For those of you that do trade on an intraday basis, you almost have to stop looking as much at the advanced decline line. The advanced decline line is just downright, it's wrong. From there, one of the other things that was perplexing throughout the course of today's trade was volatility. Now, when you look at the VIX, you would have expected the S&Ps are up 0.7%, the Nasdaq's flying over here. The VIX found the floor, and that's why I wanted to actually bring up the VIX. Okay, the VIX looks like, again, and I've been talking about this extensively, like it found a very definitive floor. And when I say a definitive floor, somewhere right around this 24, 25 level, the VIX continually bounces up from that. We're going to watch this in the days to come, because if this rally is more persistent, you would think that the VIX would fall off, but it's not. In fact, when it comes to volatility, the volatility futures, they failed to budge to the downside. You even look at stuff like the VVIX, right, which is the volatility of the volatility index, it is still in the quintessential, what we term Vomma Zone. The Vomma Zone is anything, okay, north of the 110 level. And, talk about a floor. This is kind of ironic, because this Vomma Zone, this is a line, okay, that we drew literally years ago. So we drew this line like years ago. It's something we've talked about extensively. When the VVIX gets into that zone, it's kind of duck and cover. And there's one thing that I just will not let go of, and that's this. Okay, I don't care if the S&Ps are approaching very close to all-time highs. You have a volatility. All right, and the whole volatility construct, and that's the volatility futures and the VVIX and the VIX itself. You have the whole volatility construct in an extraordinarily dangerous place when you're up here north of 110 in the VVIX. Don't forget it, because in this particular range, this is anything's possible, anything's plausible, and that's right there. This is what makes me want to continue to take some outlier type trades. Now, other aspects that I think that are worth mentioning, the dollar. It's very rare on any evening video. Okay, before I even bring it up over here, it's really rare that I ever talk specifically about the dollar or currencies over here. But this one begs to be discussed, because the dollar has been on a one-way ticket to the downside. Is this going to be a bounce, short-lived? Okay, or is the dollar getting ready to rip? You know what? People have been making a really big deal over the dollar, and I'll counter that. I don't think it's a big deal. We've actually seen, wild slides in the dollar. You don't have to go back that many years to actually see this back into 2017, which was a wicked up year, but this was a wild slide at the downside. Hey, call me crazy, but until we get down to the 90 handle inside of the dollar, I'm not going to get excited about the project. And I got to tell you, the slightest reversal back to the upside could actually cause some sell-side activity, all right, to some of the commodity products, specifically gold, but could also cause some sell-side activity to the broader S&Ps. I'm telling you, the next couple of days, watch the dollar, because if it is going to bounce, we're going to rock it to 95 like it is nothing out there. All right, to completely switch gears, I also want to bring back up the S&Ps. The reason I want to bring the S&Ps in this particular case, I'm going to go ahead and I'm actually going to bring up the SPY. And the reason I want to bring up the spiders is I want to kind of detail a really specific, range that we've been trading in. And here we are. Okay. And in fact, I'm going to close out of this, that little box right over there is right my way. So I just want you to see that we have effectively at this point in time broken out a little bit to the upside. So the marketplace, again, we slipped, we rallied, right? We slipped a little bit, we rallied, we just popped to the outside of this kind of quintessential like volatility box on us. With that, all right, I am of the strong belief that at this point in time, we absolutely have to go up to flush out a lot of the shorts to effectively be able to go down. That's what I kind of meant by, tonight's title, hey, The market's got to break out to be able to break down. This is what we should see. This is, again, you've got to get out there. And if you take a look specifically at the QQQ, in fact, to open up a broader chart on the QQQ, you're there today. This is, okay, again, effectively a breakout to the upside. And as I talked about in the weekend video, and I talked a lot about last week, I've actually been protecting myself from this break to the upside, and I've actually been using, okay, back spreads. So what a back spread happens to be, and I'll just kind of detail this right here, okay, I'm effectively selling one of these to turn around and buy, okay, two of these. Now the trade I'm showing you right now, this one's already deep in the money. I mean, really, this thing has actually been working phenomenally at this point in time. This is not, okay, the trade I'm showing you right now is not something that you can run out and put on. But I want you guys to understand that, yes, I maintain bearish positions, and I wear that, okay, like a badge of honor. But at the same time that I'm like wearing those bearish positions like a badge of honor, and believe me, I take a whole lot of crap and email for that. At the same time I'm doing that, what do you think? I'm not going to sit here and hedge? I'm using, okay, spreads like this. I mean, look, the long option where I'm long, for instance, two of these, that thing's already up to a 60 delta. I mean, this is almost a pure one-for-one offset. I'm not closing the trade because it's profitable. I'm holding on to this. It's a hedge, okay? The QQQ and Spider back spreads that have got on right now are the only thing standing from me and losses. Those back spreads are profitable to the upside. So, call it what you will. Maybe you think that this is an amazing breakout. Again, I think it's a breakout to ultimately turn around and break back down. But as we break out to the upside, okay, I've got those back spreads on. You got to hedge, all right, that upside risk. Watch your head to the upside? Well, you're waiting for the downside. Again, the marketplace, as I said a moment ago, and then there were two. There isn't a lot driving, okay, order flow here. For the most part, what you can actually see and what you can do is literally drive trade into a handful of stocks. In this case, Microsoft and Apple. The S&Ps will move with it. NASDAQ will move with it. Volatility doesn't seem to be able to back off over here, okay? There's no degree of correlation. Like if you don't see the danger in this, okay, we got problems. You got to understand, if you're bullish right now, totally fine with it. If you think that this is a huge breakout, I'm totally fine with it. But at the exact same time, you better define your risk. This is not a time to substantiate why you should be buying a ton of stock. This is not a time to be loading up on a 401k. This is a time that if you're bullish, ride it to the upside. You could ride no more. Because when it comes down, things are going to be violent. Thanks, everybody, for joining us here at Theo Trade. Have a wonderful evening. Bye-bye.